Hello, everyone. Hello. Yes. How is everyone doing? I hope you are well. We are going to get right into things. So what I do in a nutshell is I help women make smarter decisions about their personal finances and investments to help empower your lives. And now, if the word millionaire, or better yet, millionaires, grabs your attention, you're tuning into the right session. Because what I do is I work with millionaires and millionairesses every day of all different shapes and sizes, and I observe their different habits and how they got to where they are. And because of that, I know how to turn each and every one of you here listening into a millionaires. Now, you might be thinking, oh gosh, I think I'm a little late to the game. And if that's the case, at least we can help get you to a place where you are financially secure. Okay. So to start off, let's go ahead. Let's take a look at some of these millionaires and millionairesses. All right. So please advance the slide, Ginger, if you would. One more. All right. So take a look at this. Go ahead and tell me, or think to yourselves rather, what comes to mind when you look at this gentleman here and his car? And a lot of times when I present this live, I hear people shout things out like Richie Rich, billionaire, founder. One woman once yelled out, midlife crisis, which I thought was great. And that may or may not be the case, but I'll tell you, I based this slide off of a real person who came in to see me and get an assessment of his personal finances and investments. The only difference is he was about the same age. The only difference is his Porsche was gray, but I thought the red here really stuck out better. And when we dug into his finances, the first thing he told me is, oh, I can't wait to retire in 3 years. And I said, oh, okay, well, let's take a look at things. I love finance. I love numbers because they don't lie. And I've come to find out that the car, his Porsche, was leased. His home was rented. And his balance sheet, boy, looked really empty. And so, bottom line, he is not where you want to be. Please advance the next slide. All right. What comes to mind here when you look at this woman? And you might be thinking to yourselves, well, not much. There are no logos, no brand names covering her. She looks like just an ordinary person. And I chose this photo because this really represents a lot of the people that I work with. She looks like a lot of them, and that nothing really sticks out. She's not trying to impress anyone because, as it turns out, she doesn't need to impress anybody. She's the one with all the money. She is the millionaires. And don't get me wrong, these are not the Real Housewives of Beverly Hills that are trying to fake it. These are the actual millionairesses of Massachusetts. Okay. And when I say millionaires, I mean it. 45% of millionaires in the state are women. All right. So I want to bring you into the mindset of a millionaire and millionaires now that I've shown you a bit of what they actually look like. And so I'm going to ask you some questions, and I want you to think these questions through. And Ginger, feel free if you want to just change it so people just see me talking to them live. That's fine, because we're pretty much done with the slides. There's one last one with my contact info and bio, but for the most part, I just want to talk to people directly and keep their attention. So first question I'm going to ask you is, how much do you think a typical millionaire or millionaires makes annually from income? How much do you think they earn? And a lot of people will often guess, oh, $1 million. Well, no, it's not quite that high. And when I'm talking about being a millionaire, I mean your whole net worth is worth $1 million. Okay. So the average income tends to be a range between $100,000 and $250,000. Not as high as people think. They aren't the 1%ers. Okay, it doesn't take that much income to be millionaires. What do and actually I'll share a story. One of my favorite clients, she's a school teacher, hardly, never really earned over 100,000 until her more recent years as a school teacher. She's 61 and she comes in. I always greet her as a millionaires. And she laughs and she loves it. And I really applaud her because she's a great example of somebody who realize that it's not how much you earn, but it's how much you keep. Okay. So the millionaires make sure no matter how much they're earning, they are paying themselves first. They are finding some money to carve it out for themselves and their future selves. Next question. What do they, the millionaires and millionaires, what do they hate the most? And yes, hate is a strong word. What do they hate the most? You might think taxes. That's probably number 2. What they hate the most is debt, because they realize that they don't want to be in the camp where they are paying unnecessary interest when there's debt involved. They want to be on the other side where they are collecting the interest, which we'll get into in a little bit. Okay, so when it comes to debt, if you do have debt now, the only kind of debt that is acceptable, really, if you're in strong financial health, is a mortgage, because you're building equity. Other kind of debt, you want to work to exterminate that, get it behind you, and not pay the unnecessary interest along the way. All right, how much money do you think millionaires and millionairesses get from their parents on average? You may be thinking, oh, these are the silver spoon kids. These are the trust fund babies. Well, the reality is that most millionaires are self-made, first-generation wealthy. And so if for parents on the call, I want you to really take this to heart, because easy come, easy go. Giving oftentimes precipitates consumption and spending, okay? Not saving. And so I know as a parent, you have the challenge, you want your children to have better than you had, but what does better mean? Does that mean more things? Does that mean more money? What you certainly don't want to do is take away the work, part of the struggle, part of the storyline that can help them become tough and help them have the characteristic traits to be financially strong, okay? All right, last question. What is the favorite wine for a millionaire and millionaires? Merlot? Is it Saint Blanc? Cabernet? No, it's not a white or red, nor is it a mix of the two. It's not a rosé. It's free wine, okay? So there's a little millionaire in all of us, if that's the case. But the point I'm making is that it's not really about the materialistic stuff for them, okay? Again, it's easier to fake it than make it. And sure, they have nice things, but they plan for them. They spend intentionally from a position of strength. To them, they value more the intangibles, experiences, relationships, their family, health, being financially independent, and making sure they are bulletproof for whatever life throws their way, because all we can expect is change. And not being reliant on anyone else, spouse or otherwise. So bottom line, the mindset there, being self-reliant, live below your means, and having your priorities straight. Okay? So enough about them. Let's talk about you. What are the actionable steps you need to take to get to a financially strong position for yourselves? Well, I'll give you some raw numbers. Let's say you are starting off with $0 in your pocket, and you're tuning in and you are 25 years young. And let's say you're investing in, I don't know, S&P 500, or rather something that yields 9% return over time, similar to the S&P 500. And you want to know how much money you have to save each month to become a millionaire at age 65. Well, if you're starting off at the tender age of 25, the amount you have to save is $250. If you're starting off at 30, it's $400. If you're starting off at 35, $650. Oof, getting tougher. If you're starting off at 40, it's $1,000. If you're starting off at 45, it's $1,600. And if you're starting off at 55, it's $5,500. Ouch. You don't want to be there. Okay. And as you can see, the sooner you start, the easier, less painful it is. Okay. Put differently, let's say a famous couple, Beyonce and Jay-Z. She's on tour right now. I saw her at Gillette. She was great. So let's use them as an example. And you're going to like this. I'm going to make them more like us. I'm going to take away a lot of their money and make them more relatable. So let's say Jay-Z and Beyonce, let's say they're the same age. Let's go back in time to when Beyonce was 21 years old, performing. And our momager told her, hey, make sure you save. Okay. So let's assume she saved $100 at 21, $100 a month, all the way from 21 till 65. And let's assume for easy numbers' sake, she got a 10% return, maybe investing in something like the S&P 500 again, which averages that over a 10-year or 50-year span. So that was her. Now, Jay-Z, let's assume he wasn't paying attention and didn't really do a thing, didn't save anything until he was 31. Okay, so instead of starting at 21, he started at 31, 10 years later, and he saved the exact same $100 in the exact same fund that gave a return of 10%. And let's now fast forward to when they're both 65, okay? How much does each of them have saved and invested at that point? How much has all that money bubbled up into? For Beyonce, it's $1 million. Go her. For Jay-Z, now mind you, he only started 10 years later, did everything else exactly like she did. The amount he will have saved up is, at 65, only not $1 million, but $300,000. Ouch. That's $700,000 he just allowed to slip through his fingers, not paying attention young enough, soon enough. So if you're wondering, when should I start? The time is now. For the younger people in your lives, make sure you pass on this message to start now, because time really is money. Okay, there's a reason why Albert Einstein called it the fifth wonder of the world of compounding interest. It's incredible what time can do to money. In fact, if you had $10,000 invested in the S&P 500 in the 1970, today it would be worth over $2 million. Okay, it's the power of compounding interest. All right, other things for you to do to help make sure your foundation is solid. Well, you want to make sure you have an emergency fund, yes, for that rainy day, and also to make sure you're not on a hamster wheel of revolving debt, okay? Because only then, once you have that emergency fund, and when life happens, you need to pull from that, that's the only way you can really stop the chronic cycle of getting into credit card debt. The amount of emergency fund I like is, you probably heard this too, 6 to 9 months of your income or to pay for your expenses, and that's good. Okay, if you want more than that, if you need more than that to feel secure, great, have more than that. Okay, and also for debt. Now, if it's credit card or student loan debt or car loan, whatever kind of debt you have, I want you to be smart about how you pay it off. You want to do it effectively and efficiently. The best way to do that is not paying a little bit at everybody all at once. The best thing is to triage your debt and pay most towards whatever debt has the highest interest rate. It's all about the interest rate. So if you have a credit card that's charging you a 20% interest rate, and you'll be surprised if you're not sure how much you're being charged, how high it is. Let's say you're being charged 20% and everything else is in the teens. You want to focus on that 20% credit card balance, because that is burning the deepest hole in your pocket, and you want to stop paying that 20% interest. It's unnecessary. So you want to pay that, prioritize that, and minimums on everything else. Okay. And then once that's gone, you then work your way down. Okay. All right, so we've talked about emergency fund, we've talked about debt. Now, let's go back to your savings that you have accumulating. And you may be wondering, well, all right, how do I invest this? Okay. The best way to, or there are two basically ways to invest, okay? The best way to accumulate the money is make it automatic no matter what you do, whether it's through your 401k at work, or it's an IRA you set up for yourself. If you're a business owner, there are these things called the SEP IRAs, SEP IRAs. Basically, there's no excuse not to have some kind of retirement bucket set aside, and that retirement bucket will grow larger and faster because of the tax advantage than a non-retirement account. Okay, so once you have your savings going, automate them so it actually happens. You don't have to think about it. You just set it and forget it. And when it comes to investing, liquid investments, there's two types, okay? There is the stock market, okay, which is you own a portion of a company, And with that ownership, you're on the roller coaster ride if the company does well or not well, okay? Or the entire S&P 500, those are the 500 largest companies all at once, okay? You're on the ride for the valuation in the stock market, okay? And that ride and risk is not a bad thing because that allows for returns as well, okay? And I also don't want you to be scared. There's these scary things called these recessions. But I want you to keep in the back of your mind, as long as your investments are solid and diversified, they depending on the investments, they likely will come back. Like the S&P 500 hasn't been a straight line in the stock market since 1970 till today. Of course not, but it's been a trending line in the upward direction. Okay. And of course, it comes with a lot of jagged edges in between. And recessions are a normal thing. I know it's very scary to hear that, but they are normal. They come roughly every 10 years. Luckily, they don't last that long. And every single time, a recession has been followed by a roaring market to the upside. So making a lot of money coming out of those downward markets. And the market has always come back to its high water mark and continued to march higher. Okay, so investing in the stock market really is a belief in capitalism. It's not perfect, but it certainly is something that has worked fairly well since the U.S. has been in existence. So that's the stock market. And you may be hearing, oh, gosh, it's recession, or oh, gosh, the market went down. But really, those are the best times to invest, okay, because you want to buy low, sell high. You don't want to, you often want to be a contrarian and doing the opposite of what your emotions are telling you, so long as, again, your investments are good investments, okay? So that's the stock market portion of things. And yes, the market has come down from the beginning of last year. But again, when the market's down, that's generally an opportunity to buy because you're buying on sale. And we all love the clearance rack. And next, so there's a stock market part to invest. And then the second part of liquid investments is this thing called fixed income. Basically, think of it as your life vest that you wear. So that way, when the stock market's going up and down, again, that's your life vest. Just like in the water, when the waves come crashing up and down, it keeps you afloat. It keeps you more steady. And the more and the bigger your life jacket, the more steady you are, okay? And the more that you own, the less risky overall, the more conservative, the more protective. And as you get older, you want to have more of that stuff. Now, what is that stuff? Basically, it's things like a CD or a treasury bill or a bond where you are loaning money and collecting interest, like the millionaires, okay? Collecting interest, not paying it, okay? And right now, it's actually a really interesting time. A lot of times when I talk about CDs or bonds in the past, people kind of glaze over and think, oh, this is boring. It's actually really exciting right now because we are at 22-year highs when it comes to fixed income and rates. All of a result of combating inflation, the government has jacked up interest rates to slow down the economy or try to slow down the economy. And rates went basically from 0 to about 5% right now. And CDs used to clamor to try to get around 2%, and now you can get around 5%. So it's really exciting to see what's out there. And it's really indication if you have money just kind of sitting there to potentially put it to work. So your money is going to work and making something for you, okay? You want to turn your money into a lean money-making machine for you, okay? So those are things to bear in mind. And also these higher rates aren't going to be here most likely forever, and they will go down. So it's important now to pay attention and potentially lock up some money in these bonds or CDs or treasury bills that have these higher interest rates around over 4%, over 5% now, before rates go back down. Okay, so there's a likely limited window of opportunity here to really pay attention to this and potentially act. All right, so we talked about your investments. Next, I want to shift gears a little bit because I want to make sure I get something, at least one really good takeaway for everybody on the call. So if you have children, when it comes to college, one of the best things when it comes to college, how you can help your children is help them realize that, you know, where they go and where they go for you and for them. It's not a reflection of how you did as a parent. And it's not a reflection of how they will do in the future. Have them realize the potential financial burden if they go to a very high sticker price school, and help them understand and really put in perspective a $250,000 investment and what that would mean for them to graduate with that burden of debt. So help them realize that they really should be looking and making smart financial decisions and go to schools that give them the most money, or a school that isn't as expensive as another one of the schools they may be looking at. Now, when it comes to college, a lot of parents are quick to write themselves off and say, oh, maybe my husband and I, we're making too much money and we're not going to qualify for any financial aid. And so we're not going to bother filling out FAFSA. What I'll tell you is always fill out FAFSA, because even if you don't apply for financial aid, you and your child, let's say a parent loses their job. It happens. And now suddenly you're eligible financially for financial aid. Well, if you didn't fill out FAFSA, you won't get financial aid. Okay, so make sure you're filling out FAFSA in a way it works as a bit of insurance. Okay, also, understanding college and what they look at is crucial. So, for example, when it comes to college, you understand they look at your assets and income. And a lot of colleges use your child and your income. And a lot of times they use a base case snapshot of when your child is when they're a sophomore in January, that calendar year. So that's the year to look as, let me get the technical term for this, look as poor as possible. Okay, if you're able to defer a bonus that calendar year, or you're a business owner and you can really modulate how much income you receive, that's the year to show the least amount of income. Okay, asset-wise, colleges don't account for money put in retirement. So just another reason to make sure you sock money away for your future selves. And they do look at money in those college funds, those 529s, which I know a lot of people, there's that potential myth out there that what you put in a college fund will get used against you. Well, potentially, yes. But here's the workaround. For these college funds, oftentimes the parent is the owner and the child is the beneficiary. After all, you own everything else, the clothes on their backs and the roof over their head. But it may be smarter to actually not have yourself be the owner, because then the colleges will see it as an asset and use it again against your child's eligibility to get financial aid. So what you can do instead is have a grandparent, the healthiest, youngest grandparents, be the owner. That way, colleges then magically just don't see those savings on the ledger. Okay. All right. Other things we're going to move through real quickly here is negotiating, making more money. We can save, but I also want to make sure you are negotiating and asking for more money. And we're talking to women here, and we all know there is that pay gap. So we need to do our part too to make sure we are closing that pay gap and getting what is ours and getting fairly compensated. So here's some tips. When you are going in for a job, I'm going to share with you the one thing that HR professionals don't want me to tell you. And that is you need to negotiate. 95% of them are willing to negotiate. Okay. So what that means is when you get your offer and they say, oh, you're doing so great, we would love to have you on the team starting Monday. Here's, $100,000, whatever it is. Say anything but yes. Okay. Never accept the first offer. Instead, say something like, thank you for the offer, but I'm surprised to see the pay is so low. Thank you for the offer, but I'm having trouble saying yes. Thank you for the offer, but I'm going to have to take the night to weigh this out with my other offers. Okay. By taking pause, it shows your maturity and it shows your confidence. And don't worry, they're not going to rescind the offer. Okay. If anything, the opposite will happen. They're just going to want you that much more. It's kind of like when a guy friend of yours finally asks you out on a date and you hesitate to respond. And, it just it adds to the momentum of the ask. Okay. So recognize when they come to you with the offer, you have the upper hand. You're not going to have more pull than when they're making the offer, because the ball is in your court. So bask in that power and use it to your advantage. Now, if you're in an existing job and you've experienced job creep where you're hired to do A through C and suddenly you're doing A through Z, well, that's fine, but you need to be compensated for it. And remember, we all work to make money. And I want you to really internalize that. We work to make money, and that's okay. There's nothing wrong with us working to make money. Yes, we want to do something that has impact and we feel good about it, we feel fulfilled, is in line with who we are, absolutely. And at the same time, we work to make money. So the more comfortable you are in that realization, the easier it is to have conversations about money and what you are being compensated. And so again, when you're already employed and you want to get a pay increase, don't ask for a raise, ask for a salary adjustment. A raise indicates a smaller adjustment. A salary adjustment connotates a much larger increase in pay. And you want to be collaborative, not combative. I'm assuming you want to keep the job. So really you want to use a phrase, something like, how do we fix this pay gap with these new priorities and tasks I've taken on? And when they compliment you, the door is open to have that conversation then, right? All right. And I'm going to move on one last item here and talk about another topic that really affects women. Probably one you're not thinking I was going to cover, but I'm going to do it anyways. And that is Social Security. And I know a lot of you are thinking, oh, Social Security, especially if you're younger, how does it affect me? It's not for so long. Well, even if you have parents or grandparents, it affects them. So it's important for you to still pay attention, even if you're in your 20s or 30s, right? And Social Security is a women's issue because so much money is being left on the table by women because we don't know what the rules are. And we are living longer than men. So we can implement more of these strategies. And the system has been outdated since the 1930s. A lot of the rules back then have not been changed. And one thing that certainly has changed is the fact that we are working women a lot of the time. So we are two dual income households. So we can really strategize and use this to our advantage. So here are a couple hacks, okay? First, if you're single, that's the biggest hack when it comes to Social Security. You can collect as soon as 62, or you can wait. You can wait to collect. Your full retirement age is somewhere between 66 and 67, depending on the year you're born. And you can wait all the way up until 70 to collect your Social Security. Now, if you collect as soon as 62, you get a haircut, shaving off 25 to 30% of what the government promised you. Not good. If you wait until 70, every year you wait until after your full retirement age, somewhere between 66 and 67, you get an 8% increase in pay. Okay, you get a pay raise for the rest of your life. Okay, so it's important to wait. Okay, if you are married, a little hack here is that you have an option. You can collect either 100% of your benefits or 108% if you wait till 68, or 116% if you wait until 69, or 124% if you wait until 70. Okay. Or you can collect half, an amount equal to half of your spouse's benefit, whichever is larger. Okay. And by the way, Social Security is not peanuts. I was just talking to someone, he's collecting now at 70, he's collecting over $4,000 a month. It is not peanuts. And the cumulative amount people can collect, let's say dual income has been 100,000, over a 20-year span, the cumulative amount people collect from Social Security on average is over $1 million. It is not peanuts. It is worth paying attention to and strategizing around. Next, what about if you are divorced? Any benefits there in the eyes of Social Security? Well, yeah. The hack there, again, is, well, you have the same options as if you were married, as long as you were married for 10 years. Okay? That is the important cutoff. And I do a lot of work with people who are divorced, helping them figure out the better outcomes during divorce and thereafter, and do they keep the house, all of that. And one of the first questions I ask is, how long have you been married? Because you want to make sure you pass that 10-year mark. Okay, that's a crucial piece. Also, what if you have multiple exes, like my Uncle Jimmy? We stopped buying wedding gifts by the third wedding. God love him, hopeless romantic. If you multiple exes, then you can choose whichever benefit is higher, as long as you've been married for 10 years in each of those marriages. And if you were the breadwinner, you could have exes collecting off of your benefit history, but don't worry, you won't even know it. It doesn't affect your personal earnings or in what you could be collecting. And how about if you're widowed? Now, again, this could be your parent or could be a grandparent. I would say 8 out of 10 times I find extra money for widows because the rules are so generous. Again, these rules were created in the 1930s when if a husband didn't come back from war, it was detrimental to the finances of the family. And the other day I found a mother and daughter came in to see me trying to get more money for mom for her assisted living. And we found an extra $1,800 a month just through Social Security because she's a widow. And how it works when you're a widow is you can collect off of your own earning history, or up to 100% of what he or she was collecting at the time of death. Okay, you could switch back and forth between the two. All right, so lots to consider there. And I'm going to end off just saying how important it is that you know where you stand. Stepping on the financial scale, as I like to say, is so important. So you know, how are you tracking? What small changes should you make to your savings rate, to your investments, so you can save for your future stuff, your retirement, your second home or first home or college, whatever the goal is. Oftentimes, there's really small tweaks you can make now that drastically affect your future. So consult with someone like myself, a financial advisor, or someone like myself to really get you answers to questions you have. And the beautiful thing about finances is that it's a mathematical equation. There is an answer to every question that you have. So the toughest part of everything I've mentioned is executing. And boy, oh boy, do millionaires execute. And I've shed some light on what needs to get done in this quick half hour. I've shared with you how millionaires think, how they behave, and now it's on you to act. So grab the bull by the horn and make it happen. You've got this, and good luck.
Nora, thank you so much for that wonderful presentation. You gave us a lot to think about and a lot of wonderful reminders. So every time I give Nora's presentation, I want Nora, I know that if we might get a lot of questions, so make sure to say that, this is specific for that person or whatever you need to say. So I'll start with this question from Anya. This came in earlier in your presentation, and I think you were talking about savings for the year. And she says, what about these higher APY savings accounts versus putting money in your Roth IRA for this year?
Yeah. So here's the thing. A Roth is a bucket. Okay. So you can decide in that bucket how you want to invest inside that bucket. You can invest in a high yield savings account within that Roth. You can, or equivalents, or a money market, or a treasury bill, similar to that high yield savings account. But the Roth is a distinction. It's the bucket. And the beauty of the Roth is that you're putting money in after tax, and you're going to allow it to build. So any profits it makes, you don't pay taxes on ever. Okay. And when you take the money out, you don't pay taxes either because you've already paid the taxes. Okay. So depending on your situation, all things being equal, if you already have an emergency fund, I'm a fan of the Roth IRA. And if that makes sense for you, meaning if you're not at the highest tax bracket you think you'll ever be in, if you think you're at a lower tax bracket and later in life you'll earn more income, do the Roth IRA all day long. And then you can decide how to invest inside of it, whether it's something similar to one of those high yield APRs or something different.
Oh, thank you for that. Well, this question from Catherine. Catherine says, wow, so good. What if you're already mid-50s and you haven't built much, just a Roth, and we don't have big money? Is there any hope to be able to save a lot at this late stage in life?
Yes, there is always hope. I am always with a can-do attitude, and I want you to have that attitude too. Yes, it all depends on how much you need really is a big piece of this. If you don't need a whole lot, you don't need to have saved a whole lot. Now, what is your magic number that you have to save? Feel free to just get in touch with me and I can run the numbers for you to see how much more you need to save to get to your goal of when you want to retire. Basically what I need to know is how much are you starting off with, what's your age, and how much do you want to have each month to live off of once you do retire. And then I can back into what that's what I like to call it magic savings number needs to be. And for free, Ginger, I know we took off the slides. My last slide did have all my contact info. So if you want to throw it back on, feel free.
Yeah, I'll put that back up. Yes. So so I get that back up. I guess the next question would be, I've had a couple of questions about this that are the same, but so I'm going to go with this one from Gabriella. My company does not provide 401k. What is better for my retirement savings, a traditional or Roth IRA? She says, I'm 15 years from retirement and children are out of college.
And children are out of college. Okay. So generally at that point in time, I'd probably, and again, I'd have to dig in a little more impersonally, but in general, if you're at the highest tax bracket you're earning the most income you're probably going to be earning. In that case, I'm a fan of the traditional IRA. And that way you're putting money in, but before you're taking taxes, because you don't want to pay high taxes when you're at your higher income tax bracket, because then when you retire, you'll be at a lower tax bracket. So it's better to do that traditional IRA at this point at age and stage. And then when you're retired, you'll be earning less income, if any, and you'll be at a much lower tax bracket. So when you take the money out of the IRA, you'll get taxed at a lower tax bracket.
Wonderful. All right, I'm going to ask it one more time because it was asked a second time. And I guess the question is, what is the biggest difference between the traditional and the Roth IRA?
Yes, great question. So it's all a tax difference. The difference is with a traditional IRA, you don't pay any taxes yet until you take the money out. And when you take the money out, it counts as taxable income. With the Roth, it's the opposite. You put money in that's already been taxed. So when you take the money out, once you're retired, none of it counts as taxable income. And the beauty with both of them is that if you start off, let's say with $10,000 and it grows to $100,000, you pay zero money on all that profit that was made, unlike a different type of investment that's non-retirement.
Ah, that's interesting. Okay. Well, thank you. Well, as we wrap up, this has been wonderful information. And I know we could all go on for hours and hours asking specific questions. But yes, I did put up Nora's information. So please reach out to her, especially if you have anything very specific to your situation. But as we wrap for the afternoon, do you have any final words of wisdom for all of our viewers today?
Take the can-do mindset and know that everything is in your control. And you've all taken the right step of arming yourself with information this afternoon.
Well, Nora, thank you for your time this afternoon.
My pleasure.
Well, thank you to all of our speakers today, both our panel members and our keynote speakers. And thank you to our viewers as well. Without all of you, these events would not be possible. So let's continue to support women's leadership and support one another. So until next time, this is Ginger Whatley signing off. Have a great afternoon, everyone.